Welcome to the Business of Property podcast. I'm Simon.
I'm Stuart.
We're both property people running our own businesses. This podcast is just us chatting, as we often do, about anything and everything property. So last week, Stuart, you slipped into the conversation that you're in the process or very early stage of looking at selling one of your rental properties as a flat that you've had for quite a while.
Yeah.
I hope we can sort of expand a bit more on that generally in this episode. But first of all, it raised a question that I didn't get a chance to ask last week, which was, are you going to be selling this tenanted, or are you planning to preemptively evict your tenant from it? Or because it does have a tenant in at the moment, doesn't it? I am right in that, first of all, I suppose.
There was a tenant, but the tenant went MIA during the COVID outbreak. So, and
they actually left the property. I thought they just stopped responding to you, but they actually disappeared.
No,
have they?
Yeah, I went to visit the property. The property was empty because the letting agent popped round, but letting agent said the curtains were closed. That's as far as they got. So I went a step further, knocked on the door and walked through the door with the keys as the letting agent could have done. But to be fair to the tenant, they left the flat in a very good condition. It was tidy, it was clean. I think, unfortunately for them, they just got a bit fearful, didn't really know how to deal with the situation, and left. They were, I believe, over from Italy, something like that. And left the property. But like I say, they left it in a good condition. So I kind of thought that we'd take advantage of the flat being empty to sell it, to put it on the market and just see what the market was like. As we mentioned last week, it feels like there is a lot of pent-up demand happening. There is market for it. So we're hopeful. And the reason we're putting that on the market is because my wife and I would like to buy. We're currently in rented, which is people always find quite ironic.
I think you do rent a small castle, don't you? I think we established previously.
I don't think so. I don't think we ever said that. I don't remember talking about. You're the one that likes moats, not me.
I think it was down to the size of your living room. I think I concluded that it must be a small castle based on that.
Well, it's not. It's a nice house, but we'd like to purchase at some point. So we were just working that out and really just seeing if we can pull together some funds, and this will be part of it. And as anyone that's had a property for any period of time, we have released capital from it over the years. It's helped us buy our first sort of property together, and so on and so forth. And because it's in Kingston upon Thames, it's increased quite a lot since my wife originally purchased it in 2003. But it's probably worth 2.5 times. Well, it is 2.5 times what it was purchased for.
So what sort of loan to value have you currently got on that?
It will be around between 70 and 75. So
a good chunk of equity there, and presumably you'll have some capital gains to pay on that as well. Have you?
Yes.
Have you worked out all those numbers and things?
No, I've instructed the accountant to do that, but I think given the sort of time of the year and everything that they've been working on, they haven't had time to get to it. But then I had an epiphany and remembered that I'd extended the lease just about 1.5 years ago, and that was cost the tidy sum of around £20,000.
Ouch. Yeah,
so it was very painful at the time, but now I'm thinking, that could help reduce the CGT liability.
So lease extension is a sort of capital investment into a property that can be taken off against or taken off as an expense against capital gains, is it?
Well, that's my hope. I don't know. So I will update.
Okay, that sounds good. Yeah, because I'm not sure on the rules around capital gains tax. I know you can sort of refurbishment investments and things like that you put into a property. They can be taken off against or taken as an expense when calculating the capital gains. It'll be interesting to see whether lease extensions do as well, because I just don't know either way.
Yes, and that's why I need to give the information to the accountant to see where we get to. Now, hopefully, even if not the full amount, some of the legal costs and around that might be able to be offset. So we'll find out.
So that answers the question about how you're going to deal with selling it tenanted or not. Presumably that means you're not putting it back on the rental market at the moment until you decide how the potential sale goes.
Yeah. Well, there's kind of two options on that. The short answer is no, we're not going to do that. However, on the flip project that we're doing in Croydon, which now I've mentioned it, we'll come on and talk about it shortly, I'm sure. But what we've done on that one is actually advertise that to rent, but for a 3-month period, even though we're going to sell it. So even though it will be going on the market to be sold, we are renting that obviously overtly as a short-term let. And in fact, we put it on the market last week and that's rented this week for around what we wanted. So no is the short answer, but I think what we want to see is just how quickly we get interest in the flat. The studio flat is I've mentioned it on the podcast before, but it's a great little flat. It's very close to Kingston train station. It's so you're very quick transport links into London via train, bus into Richmond. Also, Wimbledon's very close, so it's a great. And it's also a 10-minute. Well, it's not even 10-minute, 5-minute walk to the Thames, which we visited again as a family recently from the flat, and it's a great flat. So our hope is that it will sell fairly quickly. But if in the next couple of weeks it doesn't sort of garner the level of interest that we want, then I'll look at potentially getting someone in even for a few months just to cover the mortgage costs, which weren't being covered, as I said, because the tenant has disappeared.
Yes, indeed. So how did your conversations with agents go? And I think you mentioned in particular you had an interesting conversation with Purplebricks as well. How was that experience?
Well, I think not so much interesting conversation, but I think I learned more as we do when we engage in all of these things. I think the thing that I always take from engagements with any sort of supplier that's going to provide us with a service is how much they want the business. The first thing that I didn't realise that until I researched it is that the fees that you pay on Purplebricks are paid up front and are then for the lifetime. So on the face of it, Purplebricks and is financially a very good option. So just to put it into context, if I look at the agent that has rented the property for the last 17 years, they wanted a flat fee of £5,000 plus VAT. That equated to about 2.5%, about 2.7% of the property sale. To which my response was, "Okay, but that's great. But we've had the property with you for 17 years. I'm sure you've made a little bit of money in that time. Would there be any movement?" And the answer was no. So okay. So we've moved on. Then I looked at Purplebricks, and the Purplebricks fee is £1,500 for London, central London. I think it's about £800-900 for outside of London. And as a percentage of the target sale price, worked out about 0.6. So that's really, really good. So really interesting. Yeah. And what it got me thinking about is just how much of this we give away because of the relative price difference between the selling fee versus the sales figure of the properties is so big that sometimes we don't consider it. But at this point in time, every pound counts to us, as I'm sure it does everyone. But I think I'm giving it more attention. And so that was quite good. Versus, let's say, if we've got 1.5%, then that fee is around about, I can't do the figures in my head, but it's around about, let's say, £4,000. So with a Purplebricks fee of £1,500, we could be saving around £2,000, which is a significant amount of money.
Would that be for a full estate agency service, as in they take photos, floor plans, market it, do viewings, etc., or is it a limited service in any way?
Pretty much all of that except the viewings. So the viewings is like an extra £400.
Okay, so I mean, even that's not that much.
Even with that on, I think it was still coming out at 0.7%. So in terms of price alone, Purplebricks is looking like a very good option. My model in life, as you probably know, is that try and leverage money as much as possible. That means the outlay is zero. So where Purplebricks failed in the end was the first part was that they probably didn't follow up quick enough. If they had followed up a little bit quicker, I think the property would be on with Purplebricks now. And again, the person I dealt with, just to be really clear, was very professional, really good. I think what's happening, and it kind of alludes to our conversation last week as well as today, is that I think it's a very busy time now for estate agents. So maybe that's part of it. But
yeah,
where we got to and where I got to was, okay, we would save potentially around £2,000, but I think the big point for Purplebricks is that you pay that £1,500 and then that's paid. And that does last for the lifetime of the property, which I think is a really good thing. But this really goes on to our conversation of last week and your sort of mindset around, when you want funds in account, is that for me, it was like, well, what happens if, the market does drop off quicker, and let's say we don't sell it in a month or 2 months, and then we go into a more of a tougher period of time, then actually I've spent £1,600 plus probably more for viewings, and now I don't have anything to show for it. And with my business model, every pound counts because I'm doing other refurbs and everything else. So as much as it pained me, because I imagine we will be selling property with Purplebricks at some stage, for me it had to be, okay, well, what I'll do is I'll contact another agent, negotiate them down as much as I can, which we did, to a good 1.25, which I think is fair for the property. And that means obviously there's zero outlay from me, and we are getting the viewings done. We are, everything else gets done. And of course, we'll only pay for that once the property is sold.
How much importance would you place on sort of aligning incentives? So obviously with Purplebricks' model, you pay up front. So you could argue that they've got their money. Why are they going to care about selling your property? Whereas the traditional estate agent model, they don't get paid until they sell your property. So they have that aligned incentive with you. They want to sell the property as much as you do, hopefully, so they can get paid. Do you think that's important at all, or did that play into your decision making at all? Or?
It didn't, but I think it's a really good point. That didn't play into our thinking, but it's conversations we've had subsequently after we made the decision, actually. But I mean, obviously you'll put a lot of stock in the model itself. Purplebricks is doing very well. According to a lot of figures, they are taking, in terms of their percentage of sales and completed sales, they're growing quite well, and they have done for the last couple of years. So they're clearly doing something well and right, and they seem to be a professionally run outfit. My assumption would be that they have financial recompense for the estate agents that are attributed. So you get given an estate agent, an individual that will sort of manage your sale, if you like. And I would assume, again, I don't know, but I would assume sort of in the back end that there are some financial remunerations for people that sell them, because clearly, yes, they're getting the money up front, but if they don't push the sales through, they're not going to get further sales. So I think that exists.
Do you think the incentives might be aligned for the individuals who are working for Purplebricks, even if perhaps it's not quite so aligned at a business level? Possibly. But
you'd like to think that the business model would be geared in such a way that if they're going to put properties on, if their model is to help you sell properties, that they've got some things in place, some KPIs in place to make sure that people are pushing that. The point is, and I think your point is, that that's something that they've got to work against, because, they've got competitors now like Yopa, and they do have models where you don't have to pay up front. So they're now, interestingly, they're an online estate agent, but they are now taking on board some of the bricks and mortar estate agency principles in terms of fees back. So I think it's going to be a really interesting few years, and it'd be good to speak with a couple of our guests around how that's going to pan out, I think. But I think for us, in the end, it did come down to the fact that we did need that support, and we would want a company that was going to help push that through. And also, it came down to someone that wanted the business. There was a guy that we spoke with, very nice fella, and for Greenfields estate agents in Surbiton, and he phoned basically on a daily basis and clearly wanted the business. And for us personally, when anyone sort of really puts that desire out there, we're more inclined to want to work with them.
Yeah, I've sort of mentioned on forums and things that there are estate agents who have furloughed staff, and despite sort of the apparent busyness in the market right now, have maintained furloughed staff or even made staff redundant, some of the bigger chains, presumably leaving branches closed or at least less staffed. In your sort of search for agents and things, did you come across any that were actually closed?
None that were closed, but one of my tenants did work for an estate agent, and she was furloughed and then made redundant. So that has happened. Yeah.
So I wonder if there are any that are closed, or if they're just running on lower staff numbers.
Yeah, don't know.
The next thing we were going to interrogate you on, and you mentioned a little in that last section, was your flip project. This is your flat in Croydon, and I understand you had some news on a remortgaging effort on it, which has been a long story we've mentioned before. But what's the latest on that?
Yes, the latest is, at the time of recording, yesterday we had a valuer come round to the flat, and it valued the flat at exactly what we'd put in for. So that was really good news. So
yeah, that's excellent.
Yeah, it's fantastic news. There's always a but in property, as we know, but the monthly rental is lower than what we put in. So we put in for a monthly rent of $1,500, and the rent's coming in at $1,400 a month, which then affects the products we can get because of the rental stress testing.
Yep.
Which this is so hot off the press, we haven't yet worked through to see what that means. But given the valuation is exactly where we want it to be, it feels like we can get enough out of the property. So just in terms of a quick recap, so we bought the property, actually completed on it in October 2019. We purchased it for $230, and we've spent a fair amount on it, but the revaluation is coming in at $350. So that's basically 50% higher, but that's because we've added value to it in terms of adding room and so on and so forth.
Yep.
We are flipping it, so the intention is to sell it. But yeah, as mentioned previously, we have got someone in for a 3-month short-term let that is fully cognizant that we are putting it on the market, and they're happy because they just need a short-term fix. And interesting, talking about online estate agents, my sort of business partner or JV partner on this one, he uses an account called Visium, which he pays I think £90 for. He did all the photos of the property. He's putting it on Rightmove for the short-term rent, and he's rented it within a week. So it's possible. These things are possible, and I think Purplebricks, just going back to that, is a good opportunity. I think that people of our generation and the like, I think we need to get used to these alternatives. I think before we fully commit, certainly I do, and I think the paying up front was just the bitterest pill to swallow, which we didn't go for. But so the valuation is good. The challenge for us, really alluding to everything that we've talked about, is just the market now. So the valuation is great at $350 to have a professional come in from a bank who are no doubt being conservative, and we are talking about Croydon here as well, which is London, so Greater London.
Yep, definitely. I have repeated disagreements with my wife about whether Croydon counts as London, but I think it does. Yeah, so do carry on.
Well, I think it does, but officially I don't know. So there would be some concern over that and where that's heading, but to have someone come in from the bank side and value it where we think it is really good. Of course, we now need to see if the market will agree.
Yeah, indeed. That's the big test, isn't it?
Yes.
On the rental side, you said you've got a tenant in there, so presumably you actually know what the rent is. So if they've come back and said the rent is less than what you're getting, can you challenge that at all? Or
it's not. It's the same.
Okay.
So I think so.
You kind of shot yourself in the foot by accepting a rent.
Well, they wouldn't have known, because we didn't know we had a tenant until the valuation. I mean, it literally all happened within 24 hours yesterday. So we said, but to be honest, it's about right. So
fair enough. Yeah.
And as valuers know, we target, let's say, £1,500 a month, and we're trying to push that limit when we know it's probably around 1,400, 1,450. The truth is, and we've both myself and the JV partner agreed, actually, if we'd have put in for the higher rate, we think we could have got it.
Mm-hmm.
But we wanted to cover the bridge payments and everything else, which is now going to happen for the next 3 months, which is great. It covers the expenditure too.
Yeah, indeed. Oh, that's all sounds very positive and good news. So, of course, we can't end on a good news story. So, one last thing I thought we were going to bring up a little today was relating to your personal property purchase, which you're working on, and you've been approaching mortgage companies to get agreements in principle and things in place. And I think you've found that your wonderful bounce back loan has resurfaced to bite again. What have you found there?
I can't believe you want to make me angry for the end of the podcast. But as we said before, as it's towards the end, it's only the diehard listeners. So it doesn't matter if we'll have to put this down as an explicit episode on the podcast, so I can swear a bit. But yeah, the truth is, so when we've talked about mortgage holidays, bounce back loans, and coronavirus business interruption loan schemes and that kind of thing, my hesitance, and I think we kind of agreed on it, was that mortgage holidays are great. And in fact, I even got advised to take one initially. A broker said, well, if things are getting tight, why don't you take a mortgage holiday? And I said, my exact words, I can't repeat, but I said something along the lines of, that'll be the last thing I do. I said, like, every penny I spend that I have the mortgage will be the things that get paid. Everything else I'll work out, but I'll pay the mortgages, because my concern, and I think a lot of people in the property industry shared it, that I spoke with anyway, was that we would be, maybe not overtly, but covertly punished for taking mortgage holidays. And my fear, given what I wanted to do in terms of remortgaging and buying other properties in the next 6 to 12 months, would be that if I took a mortgage holiday, that would come back and bite me on the bum. Is my polite way of saying it. But what I did do was get the business bounce back loan. Got the bounce back loan to potentially cover costs. Now, the good news is I actually haven't had to use it. It's sat there, and it could cover costs, and we'll probably redeploy it in other ways if we need. But it came out when I was trying to get the remortgage on the flat that we've just talked about. Actually, with the initial product, we weren't able to get it because they said that because we've had a bounce back loan. And now on my personal mortgage, although we'd submitted all of the details and everything else, and that was fine, they've now come back and said, we'd like to know if Mr. Lorden has sought any government support for the business. To which I've obviously had to reply, well, yes, I have. It's a bounce back loan. But what's clearly happening now is they are using this, and the first bank said it, this one hasn't so far, but is that it's now being put up against your criteria for affordability. So, ergo, if I've had a bounce back loan, maybe I can't afford a mortgage because I'm not able to fulfill all of my financial commitments, which I'm trying not to swear is a real... It's a real stick in the eye for those of us that are just trying to get along and make things happen and deploy things. Yeah, you could argue that bounce back loan should be used, and and I've said to them, ultimately, if it's still there, I'm happy to repay that if that helps. But
yeah, it's harsh, isn't it? And presumably they're also looking at sort of the expected outgoings, so the expected monthly cost during the time when you're repaying that loan. And as you say, of course, you may not actually ever reach that point, because if you can pay it all back or even pay a chunk of it back because you haven't actually needed to lean on those funds, then those forecast monthly costs may never materialise. So, yeah,
I think
being a bit harsh.
I mean, I'm thinking it through, and I'm applying logic to it, and I understand that, from a bank's perspective, bounce back loans had very little procedure attached to them. Obviously the CBILS didn't work because the banks weren't willing to put any risk against it. But as soon as the government removed that risk, then the bounce back loans got paid. And I guess from their point of view, they know that they have to get repaid and who haven't been through the criteria. But then equally, I have 3 years plus worth of accounts that shows what's coming through the business. I've got profitability finally in the business. It's up and down, but we're getting there. So it's all there as well. 3 years account. So it's another case of, I think, the banks really letting us down as investors and as consumers at times when we want them.
Indeed. So I think the resounding warning is beware of bounce back loans. Although to bring this around to a slightly positive tin,
go on.
While you have been asked about the bounce back loan and your situation with it, they haven't actually turned down your mortgage application, have they?
No, we're still waiting for the feedback on that. They're way past their SLA, I should hasten to add, in terms of response. But hopefully we'll get the AIP. But it's that thing I don't talk about until we've actually made the purchase, had the offer, and the purchase is completed, because I get nervous about those things. But so it hasn't negatively affected us so far. He says, touching his head and anything in the room.
We'll assume that it's all good then.
Yes, thank you, Simon. Let's take that.
So I think we're at the end of this episode, really. Unless there's anything else you want to finish up with, Stuart?
No, I think it's time to say goodbye.
Fantastic. In that case, if you're still listening, thank you very much. Please do leave us a review or a rating, or get in touch if there's anything you'd like us to mention in a future episode. And other than that, you can find more details on thebusinessofproperty.com, and we will speak to you again next week. Thank you.